Hi, this video is going to go over the answers to the problems after you work the sheet called Bonds and Long-Term Liabilities. So the things that we'll be doing in this is issuing bonds, paying interest, which includes the amortization of the discounted premium, and then recognizing a gain or loss on early redemption of a bond, and then finally looking at an amortization schedule for an installment note. Alright, so if you have any questions on any of that, I would go back to the original videos where I explain it in details, because this video is just going to go over your answers and calculate it so that you can see how to arrive at the answers. Alright, so the first one says that we have a corporation that issued $5 million of 6% 10-year bonds at face value on January 1. So the good news is that it says that it was at face value. So this is really the most simplistic kind. So whenever we issue bonds, we get cash, and it tells us that we did it at face value, which means that the $5 million is how much cash we got, and it's also how much we'll have to repay at the end. So these two numbers are equal. This means we don't need a discount or a premium. Alright, and then letter B says, prepare the first journal entry for the interest on June 30th. Well, we pay interest every 6 months, and we do the calculation, and the calculation is going to be the principal times the interest rate times time, and our principal is $5 million. Our interest rate it gives us at 6%, and times is always going to be 6/12, which is 1/2, so I'll just put in 0.5 to show that it's 1/2. And you need to see that that's what I put in. And then we'll multiply and find out how much our interest is. Alright, so our interest is $150,000. Alright, so this is going to be interest expense of $150,000 and cash, because we pay it every 6 months. We write them a check. Alright. Then we're going to prepare the journal entry to retire the bonds at the maturity date. Alright, so when we do this, I need another spot. I'll make myself one. We're going to get rid of our bonds payable, because after this entry we no longer owe them any money, of $5 million. And we need to pay them the cash, and so we'll credit cash of $5 million. Alright, so this was letter A, this was letter B, and this is letter C. Alright, so this one was simple because we issued it at face value, which means we didn't have to worry about discounted premium, which means we also didn't have to amortize a discounted premium. So let's look at number 2. On January 1, CRT issued a 5-year 4% bond with a face value of $100,000 and received $75,000. So right away, we can see that we need to pay back $100,000, but we only got $75,000. That means this bond was issued at a discount. Alright, so the first thing we're going to do is talk about how much cash we got. If we read it again, we can see that we received $75,000. That's a cash. I'm going to skip a line, and I'm going to say, I know that I always have to pay back the entire face value. So I always have to pay back $100,000. So that goes to bonds payable. So the difference, and I can look at this and I can see that I need it to be a debit of $25,000. And the account that has a debit balance is discount. I also knew it was a discount because I got less than what I have to pay back. So that is discount. Alright, then the first semi-annual interest payment on July 1. We have to think about two different things here. The first thing that we have to think about is this calculation of interest. So I'm just going to delete what I had and put in my new principal. My principal is $100,000. Remember, always face value when you do this interest calculation. My interest rate is 4%, and it's still half a year. And so when I multiply, I can see that the cash paid for interest needs to be $2,000. The other thing that I need to do is calculate how much to amortize the discount each time. So I'm going to put in my discount amount, and my discount amount is $25,000, and I got that from my entry. And then I'm going to say the number of periods. So the number of periods is going to be, this is a 5-year bond. I pay interest every 6 months. That means that I have 10 periods because there's 2 each year, 5 years. So 5 times 2 is 10. So my amortization is going to be $25,000 divided by 10. In other words, every time I pay them interest, I'm going to amortize my discount by $2,500. So at the end of the bond, it will be gone. All right, so interest expense, you just need to remember, is either cash paid plus a discount or cash paid less a premium. And I should be more specific. I should say the amortization of the discount. And I should say the amortization of the premium. All right, so let's put it into a journal entry then. This was letter A, and now this is us paying it. I start with cash because that's the simplest. Cash is always face value times contract rate times a half. So my interest is $2,000. Next, I'm going to fill in my amortization of a discount. Discount has a normal debit balance. Amortize means to get rid of it, so I'll be crediting my discount account. So I said I was going to do it by the $2,500 each time. Then I said that interest expense will be the cash paid plus the amortization of the discount. So interest expense will be $2,000 plus $2,500, so $4,500. All right, and so this is letter B. Let's do the same thing, but if we had a premium. So the concept is the same, but a premium is like a creamium, so it has a normal credit balance. Let's do it. All right, letter A. I'm looking for how much did I get when I issued this bond. It says that I issued it at 102. So the at price is how much money I got. So what I do when I see a at 102, I take the face value, and I know that 102 is really a percentage, so it's equal to 1.02. And I multiply, and that's how much money I got. So right away I can see I got more money than the face value, so we're talking about a premium. All right, I got cash of $510,000. I'm going to skip down because bonds payable is straightforward. It's always the face value. Face value is $500,000. That's how much I'll be paying back. So I can look here and I can see that in order to balance, I need a credit of $10,000. When I need a credit, it's called a premium. And you can remember that by saying premium has a credit balance. All right, now I'm ready to do letter B. So letter B says that we paid interest using semi-annual and also amortized our premium. So let's go ahead and do our amortize. I gotta fix that typo. Let's do our cash payment calculation first. All right, so how much we pay in interest is always face value times contract interest rate, and that's going to give you the interest to pay. In other words, the amount to credit cash. All right, so face value is equal to $500,000. They tell me that this is a 12% bond, 0.12, so the cash that I'm going to pay is $60,000. Let's do our amortization calculation. So amortization is going to be our premium, $10,000, divided by the number of periods. All right, so this is a 10-year bond. It pays interest twice a year, so we have 20 total periods. We divide, and this will be our semi-annual amortization. All right, so let's put it in. I start with cash because cash is the easiest. I'm going to pay them cash of $60,000. I'm going to amortize my discount by $500, my premium of $500. Premium has a normal credit balance, so when I amortize it, I will be debiting it, $500. And then back up here to this rule, interest expense, cash paid less amortization of the premium. $60,000 minus amortization of the premium will be $55,500. And that's going to be called interest expense. All right. Looking here, we are asking a question about if you have bonds that are issued at 105 and they have a par value of 100,000, that's the same thing as a face value of 100,000, then it is a premium. So interest is paid semi-annual and the bond market rate is 5% on the issue date. Are these bonds issued at a discount, premium, and par value? How would your answer change if the market interest rate was 12%? All right, so it's issued at a premium, and the reason that you can tell is because you got more money than what you have to pay back, plus it was a 10% bond, and the market rate is just 5%. So contract rate is greater than market value equals a premium. The other thing that we can do is if market rate changed to 12%, well then contract rate would be less than market rate, and that would be a discount. All right, and I would expect you to write out everything that I just said for more explanation here, but these are the short answers here. All right, a company has 10% 20-year bonds outstanding with a face value of $500,000. The company calls the bonds at 98 when the amortized discount is $15,000. Calculate the gain or loss on retirement of these bonds. So we have a formula that I like to use that says the face value of the bond, and the face value of this bond is $500,000, and then we net that with the discount or premium. So here we have a discount. Discount is contra, so it subtracts to get to the net price of the bond, so that's negative $15,000. So right now our carrying value of the bond is 500 minus 15,000. All right, so we have 485,000. And then we compare that to what we're going to get, or what we have to pay, I should say, when we call this bond. So the company calls the bonds at 98. So at 98, again, is a percentage. So we'll say the face value times 0.98, and that's how much proceeds we have to pay. So 500,000 times 0.98 is 490,000. And that's the proceeds that we have to pay. We compare 485 to 490, and we can see that that equals $5,000. And because the carrying value is less than the proceeds, we have a loss. All right, we also have to know how to put that into a journal entry. So the journal entry to retire the bonds is that we need to get rid of bonds payable. And to get rid of bonds payable, it has a normal credit balance, so to get rid of it, we're going to debit it for $500,000. And then we need to get rid of our discount. Discount has a normal debit balance, so to get rid of it, we will credit it. Then we need to show the cash, and we have to pay off a bond, so that's going to be a credit to cash, and it was 500,000 times 98%, so we found out that we had to pay off 490,000. And so if we look at this, right now on this side, I have 490 plus 15,000. 490 plus 15,000 is 505,000. I only have 500 over here, so that means I need a debit. So if I need a debit, I'm going to just put it right here. You'd have to move it around for Cengage to put it first, but if I need a debit, I'm going to debit a loss account for $5,000. If I had needed a credit, it would have been a gain, but a loss is a normal debit balance. So again, you would move this loss up here so that you weren't out of order, but this is the correct journal entry. Alright, so that is your practice on the, let's go back to the top and remind ourselves what we did. Issuing bonds at par value, issuing bond at a discount, issuing bonds at a premium, and calculating the gain or loss with an early redemption or retirement of bond. That just means that they called the bond early, and so they recognized a gain or a loss because the amount that they had to pay was different than the carrying value of the bond. So let me know if you have any questions. Thanks.